Welcome back to Business 353, Intermediate Accounting, Part 1. This week we're talking about Chapter 5 in Kieso's book on financial position and cash flows. So the relevant documentation in the CPA Canada Handbook and the IFRS standards are listed below here. So financial statement presentation is section 1400. In the CPA Handbook, the ASPE standards, as it were. International Accounting Standard 1 covers financial statement presentation, the balance sheet, current liabilities, and other things. The statement of cash flows, section 1540 and IAS 7. Financial instruments are going to be talked about later in the course in more detail, as are contingencies, but the references are shown there for those as well. So, the learning objectives for this chapter include the following 11 items or so. We're going to talk about the statement of financial position, once called the balance sheet, and the statement of cash flows, once called a bunch of other stuff from the perspective of a business. And so we'll talk about the limitations of the balance sheet and the major classifications within the balance sheet. We'll prepare a classified balance sheet, statement of financial position, and we'll talk about some information that requires additional disclosure, so some disclosure items that you need to remember in order to be able to understand all of the things that have an impact on the balance sheet. We'll talk about disclosure techniques, and then we'll deal with the statement of cash flows, something with which you're probably slightly familiar with from the previous introductory financial accounting course. We'll be dealing with it in a little more detail this time. We'll talk about the indirect method for preparing the statement of cash flows. We don't really talk about the direct method very much in either of the intermediate courses, but it's still a useful skill to have. And we actually talked about it a little bit more in the last introductory financial accounting course that we offered here at King's. We'll talk about what we can use the statement of cash flows to help us, how we can use the statement of cash flows to understand better the transactions and the financial health of the business. We'll talk about some differences between ASPE and IFRS, and then some of the things that are being worked on now with regard to these issues. So Chapter 5 presents a detailed discussion of the concepts and techniques that underlie the preparation and analysis of a statement of financial position. So along with the mechanics of preparation, we'll talk about acceptable disclosure requirements. They are examined and illustrated in our discussion today. The purpose, usefulness, and content of the statement of cash flows is also presented. So the presentation of cash flows from operating activities using the indirect approach is what we focus on here. The direct approach will be studied further in Financial Accounting Volume 2, which is Business 354 as it currently stands here at King's. So the financial statement called the Statement of Financial Position was once called a balance sheet, and I think I've probably mentioned it. My wife bought me a coffee cup one time that said, "Old accountants never die, they just lose their balance," and so that was appropriate because of the balance sheet. So now we actually have a statement of financial position. I'm not sure that that joke would carry anymore, but anyway, the statement of financial position, once called the balance sheet. For many years, financial statement users generally considered the income statement to be superior to the statement of financial position as a basis for judging the economic well-being of an enterprise. However, the statement of financial position can be a very useful financial statement. If a statement of financial position is examined carefully, users can gain a considerable amount of information related to liquidity of the business, solvency, financial flexibility. Liquidity is generally related to the amount of time that is expected to elapse until an asset is realized or otherwise converted into cash, or until a liability has to be paid. Solvency refers to the ability of an enterprise to pay its debts and related interest. So liquidity would include things like the working capital or current ratio, the quick ratio, maybe a cash ratio. Solvency would look at debt equity ratios and those sorts of things. So solvency refers to the ability of an enterprise to pay its debts and related interest. Does it have too much debt? Is it actually able to pay them? So times interest earned ratio, EBIT over interest. Interest expense would be an example of ratio that would be, well, I guess that's actually a ratio not just on the statement of financial position, but it includes an income statement component as well. Financial flexibility is the ability of an enterprise to take effective action to alter the amounts and timing of cash flows so that it can respond to unexpected needs and opportunities. So if there's a substantial amount of marketable securities in the financial statements, even though they don't have it in cash, that means that they can quickly convert the liquid assets into cash and pay their bills. So don't ignore the financial statement of financial position when you're thinking about the performance of a business. So with regard to the usefulness and purpose of the statement of financial position, one, it provides information about the entity's assets, liabilities, and equity. So the definition of assets and liabilities has undergone significant change in recent periods. So you need to make sure that you understand the new definitions and why they're appropriate for the course. We'll talk about liquidity and financial flexibility in some more detail, and we'll talk about how this financial statement helps us in assessing risk and predicting future cash flows. So the statement of financial position provides us information about the capital structure of the business. By the capital structure, we mean the mix of debt and equity in the financing of the assets. So if you look on the right-hand side of Canadian balance sheets, you'll see there's a number of different kinds of debt. Accounts payable is often treated separately. It's treated as part of working capital, but not really as a financing source, as notes payable, long-term debt, and common shares and preferred shares. Bonds payable would be another kind of debt security. So those kinds of items are part of the capital structure of the business. The base for the rates of return, return on assets and return on equity, are both taken from the statement of financial position. So the return would be the net income divided by the either average or opening return on asset number, would give us a measure of the business's ability to generate a return irrespective of the financing that's used. And ROE, as the DuPont equation tells us in the corporate finance course, it tells us that ROE is the return for equity investors after considering leverage. So if they're borrowing somebody else's money and using it to run the business, generally if things are profitable, it's even more profitable, so ROE would be higher than ROA. On the other hand, if the business is losing money, they'll lose even more because they're committed to pay interest payments on the debt, which they can't do as easily if they're not making money. If it's a loss, it's worse. If it's a gain, if it's an income position, a positive profit situation, it's better. So that's what leverage means. The fact that there's debt in the capital structure means that bad times are worse and good times are better. The statement of financial position helps us assess liquidity, solvency, and financial flexibility, as we've already discussed. So let's move along. The limitations of the statement of financial position. So criticism of the statement of financial position has revolved around the limitations of the information presented in the statement. So these limitations would include the use of historical cost. So the failure to reflect current value information is seen as a detriment. And the reason for that is that the historical cost is a sunk cost and is no longer relevant for future cash flows. However, the purpose for historical cost is more of a stewardship purpose. So we're looking at historical cost as the value that we paid in the past for the benefits that we're receiving today from that asset. We're not really in the market to sell it in most cases, so the current value may not be relevant to the issue of stewardship and determining whether management is doing a good job of acting on the owner's behalf. Another problem is the extensive use of judgments and estimates, and of course those numbers might be different from if we ask two different accountants or two different estimators what their estimate would be. It could be somewhat different. However, the structure placed on accounting standards tends to limit the amount of flexibility that's allowed within the estimates that we use. So it's not as big a problem as you might think it would be, because there are limitations on the degree to which you can exercise your judgment to establish different results. Thirdly, the failure to include items of financial value that can't be recorded objectively. The classic example is internally generated goodwill, or also human capital. So the value of the knowledge of your staff, the history, archived information of the organization isn't well recorded. And part of that is because you just don't have the control over the asset. So wouldn't meet the definition of the asset from that perspective. The problem with current value information, in response to Part A, the criticism of historical cost, concerns the reliability of that information. The estimation process involved in developing current value type information causes a concern about the objectivity of the resulting financial information. Now, secondly, the use of estimates. Use of estimates is extensive in the development of balance sheet data, and these estimates are required by generally accepted accounting principles, but they reflect the limitation of the statement of financial position. The limitation concerns the fact that the estimates are only as good as the understanding and objectivity of the person making the estimates. So the final limitation of the statement of financial position concerns the fact that some significant assets of the entity cannot be recorded objectively. Items such as human resources, the employee or the workforce, managerial skills, the customer base, the reputation of the business, can't be recorded in a way that's meaningful in the statement of financial position because such assets are very difficult to quantify. So those are the major limitations. Current value is not reflected. Estimates and judgments must be used in determining the collectability of receivables, for example, or assessing the saleability of inventory, lower of cost or market value, or net realizable value, and also in determining the useful lives of long-term assets because they may be depreciated over their useful lives. And so you need to think about potential obsolescence issues, and particularly with technologically based assets in technology, in high-tech industry. Corporations, the obsolescence, the useful life of the asset may not be in terms of its being potentially usable, but in terms of its being superseded by subsequent technology. And thirdly, it omits many items that are of financial value to the business. And of course, when we're buying the business, we're thinking about all the future cash flows implied in all of those assets. And so we would, excuse me, we would want to include that information to the extent that we can. And of course, we can't do that from an accounting perspective. So assets such as the value of the company's human resources and research and development are not reported adequately in the financial statements for us to get a good grasp of what the future cash flows are for those assets. And commitments such as leases and certain contractual relationships or contractual arrangements are reported in an off-balance sheet manner, so it's difficult to determine what the impact would be on the financial statement, on the statement of financial position, if we were to include them. And so we'll talk about those generally in the second half of the course in Financial Accounting 2 or Business 354 here at King's. Classification issues. In general, we try to classify similar items together, and so we would disclose okay, I think it's working now. Major classifications used in the statement of financial position are assets, liabilities, and shareholders or owners' equity. And these items were defined in our discussion previously in Chapter 2, so they should be familiar with you now, or familiar to you now. To provide the financial statement reader with additional information, these major classifications are divided into several sub-classifications as well. So assets are classified as current or non-current, with non-current divided among long-term investments, property, plant, and equipment, intangible assets, and other long-term assets. Liabilities are also classified as current or non-current. Shareholders' equity would include share capital and contributed surplus, retained earnings, and accumulated other comprehensive income. So these major classifications of the statement of financial positions would be defined as follows. Assets are present economic benefits that the entity has rights or access to where others do not. Liabilities would be a present economic burden or obligation that is enforceable by the creditors of the corporation. Equity or net assets is the residual interest in the entity's assets that remain after deducting its liabilities. In a business enterprise, the equity is the ownership interest. So, in disclosing information in the financial statements, items with different characteristics are separated. So, for example, related party transactions are separated from non-related party transactions because there is the potential for bias because of the non-arm's length relationship in related party transactions. Individual statement of financial position items should be reported separately and in enough detail, sufficient detail to allow users to use that information to determine the amounts, timing, and uncertainty of future cash flows. And so remember, when we talked in the corporate finance course, if you've taken it already, we say that finance is all about amounts, timing, and risk or uncertainty, usually reflected in the discount rate we use. So essentially what we're saying there is we want to be able to use our financial statement information to determine information about the value of the company and its future business transactions, and the cash flows are the source of value for the business. We also use the statement of financial position to evaluate the terms that we've talked about already: liquidity, financial flexibility, profitability in relation to the income statement, of course, and the risk of the business. So we need to disclose things like commitments to long-term liability payments and those sorts of things to make sure that people who read the financial statements know what risk they're taking if they invest in the firm. Other important ratios, such as the current ratio, we'll discuss as we go along in the individual sections of the course. So the current ratio is an assessment of liquidity. It's basically current assets divided by current liabilities. It's also called the working capital ratio in some versions of some texts. Other considerations for reporting on the statement of financial position would include the type or function of the relative asset or liability, for that matter. So classification in financial statements helps analysts by grouping items with similar characteristics and separating items with different characteristics. For example, as follows: the assets that differ in their type or function. So merchandise inventory is separated from property, plant, and equipment, for example. Liabilities that have different implications for the enterprise's financial flexibility should be treated differently. For example, separate reporting for current and long-term debt, and debt should be separated from equity because the obligations of the firm are different. Assets and liabilities with different general liquidity characteristics, so cash versus accounts receivable, should be separated and treated differently. Certain assets and liabilities and equity instruments have attributes that allow them to be measured or valued more easily. And so reporting these separately takes advantage of this characteristic. For example, monetary and non-monetary assets and liabilities are reported separately. Accounts or notes receivable, which are convertible to a specified monetary amount, and inventories or intangibles whose value is not fixed in terms of a monetary unit, should be separated out. Financial instruments should be recorded separately since fair values of them are readily available, so they are usually easy to measure. They would include cash, contractual rights to receive or obligations to deliver cash, or another financial instrument, investments in other companies. GAAP generally allows an entity to choose to value financial instruments by choosing the fair value option, where gains and losses go through net income. So in this textbook, they refer to them as fair value dash NI, so fair value through net income financial instruments. There are also the possibility that fair value for financial instruments may be just recorded in other comprehensive income. So we'll refer to those as FV-OCI for other comprehensive income. In general, financial instruments shouldn't be offset against each other, so the assets shouldn't be offset against liabilities, even though the party on the other side of the transaction may be the same party. You need to disclose the financial instruments separately. And we'll talk about that in more detail later as well. So a quick list of assets versus liabilities and equity is shown here. So the major categories of long-term investments: property, plant, and equipment, intangible assets, and other long-term assets would be non-current, and liabilities are generally current or long-term, with the the shareholders equity components that we talked about. Now, current assets. Current assets are resources that are expected to be realized in cash or sold or consumed either in 1 year or in the operating cycle, whichever is longer. I don't know of any businesses that use a normal or an operating cycle which is longer than that, although classic examples of very long business cycles would include long-term construction contracts, where the construction contract may actually be delivered over a number of years, or Georgia pines is another example where farmers in Georgia actually grow pine trees, and so it takes in the order of decades for pine trees to grow. The value of Georgia pines is that they have a very controlled environment, and so the trunks of the pines grow very straight and they're very predictable. And so Georgia pine is famous for being a fairly predictable, fairly consistent source of lumber. And of course, it takes a very long time for you to actually reap the harvest of your pine forest in Georgia. After you plant it, it takes decades for it to grow into usable product. So there certainly is the possibility of a normal operating cycle being longer than a year, but most businesses use a fiscal year of some sort, 365 days, or potentially 52 or 53 weeks. There's some flexibility in terms of the period, but in general it's a year that most companies use. There are some exceptions to a literal interpretation of the current asset definition. So these exceptions would include prepaid expenses, which are never really sold or can't actually be valued in terms of the cash, because usually when you pay prepaid expenses, you can't get the money back. So there are some weaknesses. So prepaid expenses will never be turned into cash or used to pay any current liability. It's basically just the consumption over time of the asset value that reflects the prepaid expenses value. Other exceptions to the literal interpretation of the current asset definition: resources that are expected to be realized in cash, sold, or consumed or either in 1 year or in the operating cycle, would include investments in common shares, even if they're just a temporary store of value and plan to sell them. The amount of cash that you'll get for them is not usually fixed. The subsequent year's depreciation of fixed assets. Consumption of fixed assets during the current period. Conceptually, you could treat the current period's depreciation and depreciation expenses as current assets, similar to the currently maturing portion of long-term debt, which is treated as a current portion, current long-term debt or current liabilities in the liability section. So just as you expect to pay off a certain amount of your mortgage liability in the next year, the use of the asset for the next period in producing your product or service could be treated as a current asset. We don't do that, but we could. Conceptually, it would be consistent with the idea of current assets. So current assets, exceptions. The exceptions are recognized in the accounting process and understood by most financial statement users, but there are some slight conceptual weaknesses in some of the classification of current assets. Current assets generally are presented in the statement of financial position in the order of their liquidity. So start with cash, and then short-term investments, receivables, inventories, prepaid expenses, and then any other current assets would follow. So the basic idea is we start with cash, we purchase raw materials, or if we're a merchandising firm, we purchase the finished goods. And then in a manufacturing firm, we manufacture the products and then pay our labor, pay for the raw materials and whatever overhead is required to allow us to produce our goods or services. Then we sell the product to the customers, usually for a markup. And then, of course, we're back to cash after we collect the accounts receivable from them. So that's sort of the normal current asset cycle that we expect in most businesses, which we cover in this course. Current assets include cash, and when we refer to cash, we usually refer to more generally cash and cash equivalents. So cash equivalents would be things that we can convert to cash without losing a significant amount of money, and we can convert it fairly quickly. So things like short-term liquid investments, money market mutual funds, government treasury bills, things that are not subject to substantial variation or volatility in value and are not likely to lose their value if we need to convert them to cash. It's also important that we disclose any restrictions on cash. So if the cash has been required as a result of some kind of a financing arrangement, if you've got a minimum amount of cash that you must maintain in your bank account in order for that funding arrangement to be maintained, then those restrictions would need to be placed in your financial statements, usually as a note disclosure, and that would reflect to your readers, the users of the financial statement, that the cash is not readily available for you to use. Short-term investments, investments in debt and equity securities, are presented separately, usually valued at cost or amortized cost or some measure of fair value. Recognize that there are differences between short-term and long-term investments. Long-term investments has a whole course dedicated to them in the King's roster of courses. That would be your Advanced Financial Accounting course, which is due next up in, well, it's on a 3-year rotation, so it presumably would be winter of 2019, then 2022, and so on. If we get a lot more accounting students, then we might be able to afford to make it a little bit more quickly or available to you than every 3 years, but that's generally the sequence. So one of the courses that 354, your intermediate financial accounting sets you up for, is that advanced financial accounting course. Accounts receivable. Accounts receivable should be segregated, so they show ordinary trade receivables separately from those owed by related parties. As we've mentioned, the non-arm's length relationship with related parties means that the terms, the degree to which they're controlled would be different, and the degree to which there may be some bias or influence exerted on payments of those amounts in preference of the ordinary trade receivables, and thus reflecting the risk to the owners of the investments in the firm. So that needs to be disclosed. Any other unusual items that are deemed material would need to be disclosed as well. Any receivables which are pledged as collateral are also limited in terms of the access that the investors of the company have to their value. Of course, we also know from 253, the introductory financial accounting course, that we need to value our accounts receivable net of the allowance for doubtful accounts. So we value at them at essentially net realizable value. Inventories are assets held for sale in the ordinary course of business, or in the process of production for such sale, such as raw materials, for example, or in the form of materials or supplies to be consumed in the production process or in the rendering of a service. They're valued at the lower of cost and net realizable value, with cost being determined using some kind of a cost formula, such as FIFO, weighted average, or specific identification. So these are techniques you've learned about in the previous course. These details must be disclosed in order to assist the users in understanding the amount of judgment involved in measuring inventory. So inventory needs to be treated separately in the statement of financial position. Current assets, prepaid expenses, expenditures already made for benefits, such as services such as insurance or rent, that will be received within 1 year or within the operating cycle, whichever is longer. These items are current assets because cash doesn't need to be used for them again in the current year or operating cycle because they've already been paid for. So prepaid expenses are reported at the amount of the unexpired or unconsumed cost. And so at every financial statement date, you'll need to determine whether or not the prepaid expenses have been consumed or expired and make the adjustments appropriate in the circumstances. Non-current investments are presented just below current assets in a separate section called investments. Investments that are readily marketable may be classified as current or long-term, depending on management's intent for holding them. They normally consist of things like debt securities, so held to maturity, versus measured at amortized cost. So debt securities are where we have lent our money to someone else, and so either we're holding them until the completion of the contract. So for example, bonds, if we're holding them until the maturity date, we classify them as either held to maturity or amortized cost. So amortized cost means that we amortize any excess over the face value of the bond, or any premium or discount of the value of the bond would be amortized over a period of time. For IFRS, the standard is different from ASPE. ASPE can use just an amortization of the premium or discount over time, whereas the IFRS assumes some level of facility with financial calculations, and so you would have to use your financial calculator to actually calculate the implicit interest on a much more rigorous basis for international financial reporting standards. Other non-current investments would include equity investments in subsidiaries or significantly influenced associates. So you would report the significant influence investment in the associates, any non-consolidated subsidiaries, or items over which you have no influence or control, so-called portfolio investments. Now the terminology of that is changing as well, so we will talk about that in more detail in the Advanced Financial Accounting course. Other items such as sinking funds designed to pay off liabilities, other tangible assets which are held as investments, those assets would generally be measured at cost, and we're generally looking to hold those funds aside to fulfill some kind of a future obligation. Non-current equity investments would be counted for as follows, and as we will learn more about in the Advanced Financial Accounting course. Subsidiaries are consolidated, so subsidiaries are places where, or are firms for which the accounting corporation has adequate control over the operations of the business, so that they can make decisions with all of the assets of the subsidiary. So all of the assets and liabilities of the subsidiary are actually wrapped up into the consolidated financial statements of the reporting enterprise, and the ownership of, if for example, if the reporting entity owns 70% of the shares of a subsidiary firm, and another entity outside of the reporting enterprise owns the other 30%, then the 30% is essentially treated as an obligation or a liability to offset the total assets and liabilities which are consolidated. It gets a little tricky, and so that we have a whole course to teach you about it, but the idea is basically that if you have a subsidiary which you control all of the assets, even though you have an obligation to take care of your minority shareholders. Significant influence is a situation where you have a substantial ownership but not control over another firm. In that case, you could influence the timing of dividends, so that you can actually you can demand dividends at a time in which it would help you to make your income statement look better if you were able to actually treat the income from these investments as just regular income. So the equity method says that you need to record your share of the earnings of the subsidiary or the significantly influenced investment at the time you earn them, so that you can't change the timing of the income, of the recognition of income, to fulfill your own biases. And any other non-consolidated subsidiaries or investments, for example, if you own some shares of IBM, you do not have a controlling interest or even a significant influence over the operations of IBM. So generally, they would be treated at fair value or cost, depending on the choice, which we will again talk about in the Advanced Financial Accounting course. Property, plant, and equipment are tangible capital assets, so properties of a durable nature that are used in the ongoing business operations to generate income. So examples would include land, buildings, machinery, furniture, tools, other wasting resources. Except for land, tangible assets are charged income through depreciation. Land, of course, is not depreciated. So depreciation would be charged on things like building and equipment. Depletion is the term we use for wasting resources, so oil and gas leases, mining sites, the resources that we're extracting from those kinds of wasting resources would be referred to as depletion, D-E-P-L-E-T-I-O-N, depletion. IFRS allows an option to carry these assets at fair value using a revaluation or fair value method. That wasn't available to us under the old GAAP, and it isn't available under ASPE, but IFRS allows us that potential revaluation option. But like all other assets, property, plant, and equipment are written down when they are determined to be impaired. And that's enough now. We'll talk about property, plant, and equipment later. Intangible assets are capital assets that lack physical substance. They're usually created by either contract or regulation or some sort of financial statutory authority. Excuse me. Intangible assets then are capital assets that lack physical substance. They usually have a higher degree of uncertainty concerning their future benefits. However, their benefit lies in the rights that they convey to the holder. So they exclude other people from using those rights, and that's kind of the value that they provide. So intangibles are initially recorded at cost, classified into two groups for accounting purposes: those with finite lives, generally those are amortized over their useful lives, and those with infinite lives, which are not amortized. Goodwill was amortized back when I was in school in the late 80s. We actually were required to amortize goodwill, for example, over no more than 50 years, and that was unique to Canadian accounting. Both the UK and the US did not amortize their goodwill, so we in Canada had an extra charge on our income statement that wasn't required of either the UK or the US, and so that was a big bit of controversy because we were making our financial statements uniformly look bad if our firms bought other firms. So we changed that, and now it's included with the other intangible assets which have infinite lives, and so it's just amortized. It's no longer amortized. It's actually determined. The value is determined or tested for impairment every year, and if the goodwill can be demonstrated to be impaired, then the value would be written down at a lower value. If it's not impaired, then it just continues to stay on the books until it's no longer valuable. Other examples would include patents, copyrights, franchises, goodwill, as we said, not internally created goodwill, but goodwill that you've purchased in another company, so things that you've paid extra for above the recognizable or identifiable assets. Trademarks and trade names, any kinds of secret processes, the famous $1 value of the Coca-Cola recipe, something that we've talked about in financial accounting courses for a substantial period of time. Organization costs, so the costs of actually setting up your organization or restructuring, or any of those costs that relate to the way your business is structured. All of these assets, both finite lives and infinite life, both types of intangible assets, both finite and infinite lives, are tested for impairment on a regular basis, and if the assets are determined to be impaired, they would be reduced in value. Intangibles can represent significant economic resources, but they're often ignored by financial analysts because valuation and measurement of them is difficult. So their valuation, the valuation of many intangible assets, especially those that are internally generated, such as goodwill, are never recognized at all on the statement of financial position until the company is actually sold to some other company, and when cash changes hands, then the accountants believe that there is some value there. Until that happens, we're a little concerned about the bias that you might have in just asserting that the value of your firm was higher than the historical cost of the assets reflected. So we don't let you do that. Other assets. Many companies include an other assets classification in the statement of financial position after property, plant, and equipment. And this section would include a wide variety of items that don't appear to fall clearly into one of the other classifications: investments, intangible assets, or property, plant, and equipment. Some of the more common items related in this section are deferred income tax assets. We'll talk about that in 354 in more detail. Non-current receivables, so receivables that have a long-term nature, often called notes receivable. Intangible assets, assets in special funds or advances to subsidiaries would be treated separately because they don't fall into the categories as outlined above. Deferred and future income taxes represent taxes that might be avoided or saved due to, taxes that may be avoided or saved due to deductions that a company may take in the future. So this tax deduction represents a benefit, which is something that we need to recognize on the statement of financial position. So essentially, you've prepaid your taxes. That's an asset that you can use to reduce your tax payment later. The classification of assets depends on both the nature of the item and the use to which it is put. So for example, land which is used as a factory site would be classified as property, plant, and equipment. Land owned by a realty company held for sale would be a current asset, it's inventory. A land that was held for speculative purposes, hoping that the value would go up, would be classified as a long-term investment. And idle land, or any other facilities that have been withdrawn from production, would be classified as other assets, property held for sale. So depending on the context, the nature of the item, the use to which it is put, the same asset may be treated differently among the asset categories. Current liabilities are the obligations that are reasonably expected to be liquidated either through the use of current assets or the creation of other current liabilities, again, within the next year or operating cycle. Items normally shown in the current liabilities section of the statement of financial position would include notes and accounts payable, any advances received from customers, so deferred or unearned revenue, current maturities of long-term debt, any short-term financing payable on demand, so if the creditor can demand it back without any delay, that obviously is a current liability because it may have to be paid off within the next period. Taxes payable, other accrued liabilities, derivative financial instruments often show up as current liabilities as well. Obligations due to be paid during the next year may be excluded from the current liability section if the item is expected to be refinanced through long-term debt or if the item will be paid out of non-current assets. And we'll talk about liabilities in more detail in 354. Working capital is the excess of current assets over current liabilities. This concept, sometimes referred to as net working capital, represents the net amount of a company's relatively liquid resources. So by reference to this amount, a financial statement user is able to assess the equity's margin of safety for meeting financial demands of the operating cycle. So can we actually pay our bills as they become due? While the amount of working capital has a definite relationship to liquidity, the reader must analyze the composition of the current assets to determine their nearness to cash. So if most of the current assets are in inventory, and the inventory is a seasonal kind of inventory and it's not in season right now, it could take you a while to actually translate that into cash. So you may want to calculate the quick ratio in addition to the working capital ratio to determine how quickly bills can be paid. Long-term liabilities are obligations whose settlement date extends beyond the normal operating cycle or 1 year. Examples include bonds payable, notes payable, lease obligations, pension obligations. Generally, the disclosure requirements for long-term liabilities are quite substantial as a result of various covenants and restrictions included for the protection of the lenders. Long-term liabilities that mature during the next operating cycle are classified as current liabilities if their liquidation requires use of current assets. So long-term liabilities generally fall into one of the three following categories: obligations arising from specific financing situations, such as the issuance of bonds or long-term lease obligations or long-term notes payable. Or they could be obligations arising from the ordinary enterprise's operations. So pensions are amounts that are going to be paid in the future for employment services that are used today. So pensions, future income taxes payable, would be a tax preference that we get today that we're going to have to pay for sometime in the future. So future income taxes payable as a liability are a future obligation. Obligations that depend on the occurrence or non-occurrence of one or more future events to confirm the amounts payable or the payee or the date payable would include such things as product warranties or other contingent liabilities, such as perhaps lawsuits and the potential negative outcome of a lawsuit. Any premium or discount on bonds payable would be disclosed separately as an addition to, for a premium, or subtraction from, for a discount, from the bond's face value. Also, the currently maturing portion of long-term debt would be classified as a current liability. So theoretically, any related premium or discount should also be reclassified as current if that was the case. Other supplementary information that would usually be disclosed in separate schedules within the notes to the financial statements would include the existence of any debt covenants, either negative or positive debt covenants, any restrictions, the terms of the debt, such as their maturity dates, interest rates, and amounts of any securities pledged to support the debt. Usually there's a schedule of committed payments if such commitments exist as well. Shareholders Equity section of the Statement of Financial Position includes information related to share capital, contributed surplus, retained earnings, and accumulated other comprehensive income. Preparation of the Shareholders Equity section should be approached with some care because of the various restrictions imposed by corporation laws, liability agreements, and voluntary actions of the Board of Directors. So the Shareholders Equity section is divided generally into 4 parts. Capital shares, which represents the exchange value of the shares issued. So that's what was actually received by the company in exchange for the issue of those shares. Share capital should include the amounts authorized, issued, and outstanding in its disclosure. Now, under the Canadian Business Corporations Act, a company must actually cancel shares that it repurchases. So treasury shares would only appear on the Statement of Financial Position of U.S. companies and some provincially incorporated entities, some provincially incorporated enterprises in Canada. So you wouldn't see treasury shares as we would see on firms' balance sheets in the States. Contributed surplus is a bit of a strange hybrid kind of item on the owner's equity disclosure in the Statement of Financial Position. So contributed surplus would include items such as gains from certain related party transactions. One example would be if there is a par value for the shares, which is not generally the case in most Canadian Business Corporations Act, but par value was a way of distinguishing certain issues of shares from other issues, and so anything contributed in excess of that par value would be included in contributed surplus. If you bought back shares at a premium or at a gain, so you bought them back for less than was originally paid for them, that premium would be added as contributed surplus. Other kinds of capital transactions, such as donated capital, would be included in contributed surplus as well. Retained earnings includes all of the undistributed earnings, and sometimes would be referred to as an earned surplus. It's not always a surplus, so it could actually be a deficit position. Some well-known companies, such as Twitter, have a substantial deficit in their retained earnings. And so it certainly may be the case that it's no longer an earned surplus, but an earned deficit. Retained earnings would be the undistributed earnings of the corporation, as we said, so separate disclosure would be made of any unrestricted retained earnings, which would be available for dividends, and other appropriated or restricted retained earnings, often referred to as a reserve. So a reserve for a particular purpose. And then finally, accumulated other comprehensive income, which would include unrealized gains and losses. When we use the term realized, we mean exchanged for cash or exchanged for something of value. So unrealized means that is basically a paper gain. It hasn't actually been realized by an external exchange for cash at this point. So other comprehensive income would show up on the income statement below the net income measure, and that would affect the accumulated other comprehensive income account. So accumulated other comprehensive income would include unrealized gains and losses on certain kinds of investments, gains or losses from hedging activities, gains or losses on revalued property, plant, and equipment, and some other items as well. Doesn't necessarily need to be called accumulated other comprehensive income. Other appropriate titles would be accepted. Now, you may want to take a look at illustration 5-11 in the text. It shows the shareholders' equity section from Talisman Energy, and it's a fairly complex, detailed example of a shareholders' equity section under IFRS accounting. Additional information would include supplemental information related to contingencies and provisions. So contingencies and provisions are those things related to uncertain outcomes. So the classic example would be a lawsuit. Accounting policies such as valuation methods and assumptions used, that's usually note number 1. And it allows users to interpret the numbers in a way that they can use to compare to other other firms, and perhaps the other firms would use a different accounting method, but you would want to know that in order to do the comparison properly. Any kinds of subsequent events, by which we mean events that have happened after the balance sheet date but before the financial statements have been issued, and would have a significant impact on the value of the firm if investors were to know that information. So the classic example would be their major production warehouse burning down after the year end. Particular kinds of contractual situations are disclosed in supplemental information. And so if they have a situation where they've committed themselves to buy at a certain price, and that price could actually end up in an uncompetitive position for them, they would have to disclose that information in the notes to the financial statements. Any additional detail on the statement of financial position line items would provide for elaboration or qualification of the items in the statement of financial position. Contingency and provisions would be an existing situation in which there's uncertainty about whether a gain or loss will occur, and that will finally be resolved when one or more future events occur or fail to occur. So that's the definition under ASPE, the old Canadian GAAP. So we actually would disclose that as a contingent liability in that case. So contingencies would be material or potentially material events that have an uncertain future outcome. They're normally disclosed in notes to the financial statements and can represent a possible gain or a possible loss. An example of a gain contingency would be company litigation against a third party. Typical loss contingencies relate to litigation or environmental issues, possible tax assessments, or government investigations into the activities of the business. So that's kind of the classic ASPE case. IFRS uses slightly different terminology. For example, if a company is sued and it's more likely than not that it will lose the lawsuit, the estimated loss would be set up as a provision under IFRS rather than as a contingent liability, which would be the terminology that's used in ASPE. Provision is a liability that has an uncertain timing or amount under IFRS. The methods used to value assets and allocate costs vary considerably among the statements of financial position accounts. So to help users of the financial statements understand and evaluate financial statement components and their relationships, these valuation methods are normally disclosed in a separate summary of significant accounting policies. As I said, that's usually the first note. It precedes all the other financial statement notes. In addition to contingencies and valuation methods, any contracts and negotiations of significance should be disclosed there as well. So that would include pension obligations, lease contracts, stock options, and so on. Contractual situations would be contracts and negotiations disclosed or required to be disclosed as described. It's mandatory that essential provisions of lease contracts, pension obligations, and stock option plans be clearly stated in the notes to the financial statements. See Section 3280 of the CPA Canada Handbook. For an example of contracts and commitments of various natures that would be required to be disclosed in the statement of financial position. Now, subsequent events, as I said, they're important transactions and events that occur after the fiscal year end, but before the financial statements are prepared. And so if the events provide further evidence of conditions that existed at the time or at the statement of financial position date, the financial statements would be adjusted. However, if the events indicate conditions that occurred after the financial statement date, they would be disclosed in the note if the condition causes a significant change to assets, liabilities, and or would have a significant impact on future operations, or that the classic sort of fire in the warehouse kind of example, where if the warehouse is burned down, it's obviously going to have an impact on their future obligations, even though at the end of the year the warehouse was still standing and people were happily using it to do their job. They can no longer do that. That should be disclosed as a subsequent event. Techniques of disclosure. Effective communication of the information required to be disclosed in the financial statements is an important consideration that we have as accountants. So accountants have developed certain methods that have proven useful in disclosing pertinent information. These methods are either parenthetical explanations, or notes, or supporting schedules, or cross-reference, or contra items. So a number of examples of those could be given. The balance sheet format, you can either set it up as in account form or report form. It can be either left-hand side and right-hand side, or it can be just in a linear form where you've got the assets on the top and the liabilities equity in the bottom part of the table. The statement of financial position can be presented to reflect the accounting equation, so accounting's assets on the left, liabilities and equity on the right. A more common presentation of a classified statement of financial position usually lists liability and equity below the assets. So look at illustration 5-12 in your text, for example, of a classified balance sheet, classified statement of financial position. One note on terminology: the term reserve is a term that refers only to an appropriation of retained earnings, and so it shouldn't be used in any other context in the statement of financial position. Now, moving on to the statement of cash flows. A primary objective of financial reporting is to allow financial statements the ability to assess the amounts, timing, and uncertainty of cash flows. Of course, that's an important part of valuing the company. The statement of financial position, income statement, and retained earnings statement do not provide a convenient source of information on cash flows. So in an attempt to provide a vehicle to help achieve that objective, the CPA Canada Handbook, ASPE, requires the presentation of the statement of cash flows as a basic financial statement. The primary purpose of the statement of cash flows is to allow users to assess the capacity of the enterprise to generate cash and cash equivalents, and the needs of the enterprise for cash resources in the future. In accomplishing its purpose, the statement focuses attention on three different areas related to cash flows: operating activities, which represent the principal revenue-producing activities of the enterprise, and all other activities that are not investing or financing activities. Investing activities, which represent the acquisition and disposal of long-term assets and other investments, which are not included in the cash equivalents. And then finally, financing activities, which represent activities that result in changes in the size and composition of the equity capital and borrowing of the enterprise. Non-cash transactions, which would be reflected in the balance sheet, are not reported in the statement of cash flows. They're stated as notes to the financial statements, and the terms of the exchange should be disclosed. Back when I was in your chairs, when the statement of cash flows was produced, and if there were such things as non-cash transactions, we would actually make up the two sides of the transaction. We would pretend that they were received in cash and then paid out in cash, even though it was a direct one-to-one transfer. So for example, a conversion of long-term debt to common shares, the debt portion goes down and the common shares goes up. There's no cash that transacts or changes hands. Back in the early standards for statement of cash flows, we would have recorded the conversion of long-term debt as a repayment of the long-term debt, and the common shares being issued as a receipt of cash in exchange for the common shares, even though that was actually what happened. Now, accountants are justifiably a little concerned about making up transactions to put in the financial statements, so we no longer do that. We just disclose it as notes. So that was one example of a non-cash transaction, which would be disclosed as a note to the financial statements. Another one would be an acquisition of property through direct issuance of shares or through exchange for another property. Cash wouldn't change hands, so it wouldn't show up in the face of the cash flow statement, but it would be disclosed separately in a note to the financial statements. So a quick summary of the cash inflows and outflows related to related to the statement of cash flows are shown below. So if the operating cash receipts are greater than the cash expenditures, that increases the amount of cash. Investing activities, the sale of property, plant, and equipment, the sale of debt or equity, or the collection of loans, I'll increase the cash, so the cash inflows. Financing activities would include issuance of equity securities for cash, or the issuance of debt, bonds, and notes. All of those things would increase cash, and of course the opposite would decrease cash. The basic format of the statement of cash flows is shown here. We calculated cash flow from operating activities, then investing activities, and then financing activities. That's the usual format, although it wouldn't be wrong to show the investing activities after the financing activities. Then that gives us a total increase or decrease in cash for the period. We add that to cash at the beginning of the year, which should tie into the financial statement presentation of the previous balance sheet. And that should, the total of the increase or decrease this period plus the cash at the beginning should tie into the cash at the end of the year on the current year's statement of financial position, and that would be how you would know it would be reconciled. Cash outflows represent the other half of all of the transactions, so operating cash expenditures in in excess of the cash receipts, so you pay more than you get. That would reduce the cash available. That would be a cash outflow. Investing activities when you purchase long-term assets such as property, plant, and equipment or other equity securities, or when you lend money to other entities, it would reduce the amount of cash you have. Financing activities, the payment of dividends is always a cash outflow. Redemption of debt would be when you pay off the debt that you owe. That's a cash outflow. Or reacquisition of capital stock, the repurchase of shares, would be a cash outflow. Information required to prepare a statement of cash flows would be obtained from the statement of financial position and the income statement and other selected transactions, primarily taken from the cash account. So the steps would essentially be, first of all, determine the cash provided for or used in operating, investing, and financing activities, determine the change or increase during the period, and reconcile the change in cash with the beginning and ending balances, as we saw in the format presented in the last slide. The information included in this chapter on the preparation of statement of cash flows provides a basic introduction to the concepts involved and uses a simple example to look briefly at how to calculate the cash provided by operating activities using the indirect method. The direct method is covered in Chapter 22, which doesn't show up until the next course, and it is the method preferred under GAAP, though in practice the indirect method is done well over 75% of the time. Regardless of the method used, the cash provided by operations would be the same, whether you use the direct method or the indirect method to calculate it. So, presentation methods. The direct method would identify specific cash inflows. So, for example, instead of having revenue in the income statement adjusted for the change in accounts receivable, we would directly show cash received from customers. Instead of including all of the expenses under cost of goods sold and other operating expenses adjusted for the accounts payable, we would show cash paid to suppliers and employees separately, and individual lines devoted to each kind of cash flow. The indirect method, we start with net income, assuming that it's all cash, and then we reconcile it for the cases where that's not the case. So, for example, depreciation is not a cash flow, but it is an expense, so it's deducted from net income. We add it back to fix it, to undo the impact of depreciation on cash. It shouldn't be deducted when we're looking at cash. It should be deducted when we're looking at income. Gains and losses. Gains should be subtracted and losses should be added back because the amount of cash is related to the proceeds on disposition of the asset or other instrument giving rise to the gain or loss. And so we need to include the proceeds, not the amount of the gain or loss. So we undo that in the indirect method. Both methods are acceptable. The direct method is the preferred method for GAAP. Now, why do we have a statement of cash flows? Well, the cash flow is especially useful to creditors because they want to answer the following questions. How successful is the company at actually generating cash from their operating activities? The finance people say that cash is king, or as it says here in this slide, cash is the company's lifeblood. You need to keep cash moving in order to pay your bills as they become due. And so it's important to have cash being generated in a predictable way. Other questions that investors or creditors might ask would be, what are the trends in net cash flow from operating activities over time? Are they actually increasing the amount of cash that they generate, or are they decreasing the amount of cash that they can generate? Cash, of course, is required for their payment of obligations. And so if you're interested in receiving payment for your the obligations which the company has to you, as creditors would, you would be interested in whether or not they actually are increasing or decreasing the amount of cash flow they're generating. If they're not, then what would be then a question you might ask is, what are the major reasons for the changes in cash from operating activities? Is it because, mostly because of depreciation, or is it because of the income, because of profitable operations, and it's just a timing issue? And then finally, would cash flows be sustainable over time? Can they be replicated in future years? So those are important things for the cash flow statement from the perspective of creditors. In terms of the measures, related measures, Appendix 5A talks about ratio analysis as the relationship among selected financial data. And the relationship can be expressed in terms of a percentage or a rate or just a simple proportion. So different ratios tell us different information about the companies. Ratios could be classified into 4 major types, and each different corporate finance, each different accounting textbook has their own list. Liquidity ratios measure the enterprise's short-run ability to pay its maturing obligations. So can it pay its bills? Activity ratios talk about how effectively the enterprise generates income or cash using the assets which are available to it. So we often refer to those as efficiency ratios or asset management ratios. Profitability ratios measure the degree of success or failure of a given enterprise or division for a given period of time. And so that's measuring whether they're actually increasing or creating value or decreasing the value of the organization. So things that would measure that would be their profit margins, so their net income as a percentage of the total sales, the return on equity or return on assets would be profitability ratios. Some profitability ratios may be classified as market value ratios in some textbooks. So the market value, the relationship of market value to book value, or the relationship of where am I going with this? The price earnings ratio is what I'm thinking of. So the price on the market value, the market versus the earnings per share. So the price per share divided by earnings per share, that's the price earnings ratio. It's a fairly well-known measure of the profitability of the firm and basically represents what the market is willing to pay for $1 of earnings of the company. Solvency or coverage ratios would include things that had implications for the capital structure or the degree of debt financing for the business. So essentially it's measuring the degree of protection for long-term creditors and investors. It's telling you how much debt is being used to increase the leverage in the firm. A couple of ratios which are shown here include the financial liquidity ratio, the financial liquidity ratio called the current cash debt coverage ratio. So you would look at cash provided by operating activities, so from the statement of cash flow, cash from operations, over average current liabilities, and that tells you how many times the cash generated by the business would be able to pay their current liabilities amount. So if it's a larger number, that would be better. You certainly want it to be more than one because the current liabilities have to be paid within the next year. More long-term measure, more towards the financial flexibility part of the spectrum, would be the cash debt coverage ratio. So that would be the net cash from operations divided by the average total liabilities, not just current liabilities. So how many times could you actually pay off your entire debt, including current and long-term items? So you would expect that number to be less than the current cash debt coverage ratio. And it would presumably, again, it would be better if it was larger, right? The more times you could actually pay off your liabilities from your cash from operations, the less risky the business. Free cash flow. Free cash flow is the amount of discretionary cash that the company has for purchasing additional investments, retiring debt, or simply adding to its liquidity. Free cash flow is net cash provided by operating activities, less any capital expenditures and payments for dividends. And so IFRS and ASPE treat this slightly, or treat the, no, where am I going with this? So free cash flow is something that the corporate finance people often refer to as cash flow from assets. So it's the total amount of cash which is generated by the business, and it's either paid to the creditors or to the investors. If it's paid to the investors, it may be actually paid out as dividends, or it may be paid out, or it may be retained within the company as part of retained earnings. So free cash flow from assets. Now, in terms of the comparison of IFRS and ASPE in this area, differences between IFRS and ASPE in the accounting for assets, liabilities, and shareholders' equity, the statement of financial position, statement of cash flow presentation, is summarized in illustration 5-24 of the text, so you might want to review it there. Looking ahead, as mentioned in Chapter 4, the International Accounting Standards Board and the Financial Accounting Standards Board of the States have been working to develop a joint converged standard since 2004. So it's taken them a while. In March 2006, the name of the project was changed to Financial Statement Presentation. Currently, broader project was on hold, and the ISB issued an exposure draft on the conceptual framework, and the conceptual framework is sort of the foundational structure of our thinking about financial statement presentation. So that exposure draft proposes to relabel the statement of comprehensive income, for example, as the statement of financial performance, as opposed to the statement of financial position. It's an interesting idea. Not sure how impactful it would truly be. Appendix 5A of this textbook discusses ratio analysis, as we said, in terms of the major classifications. So if you want to review your ratio analysis, that would be a good place to start. As far as that goes, that's the end of Chapter 5's lecture, and so we will leave it at that and move on to Chapter 6. Thanks for listening.